Greg McBride is the senior financial analyst for Bankrate.com. As you know, Fannie Mae and Freddie Mac handle half this nation's mortgage debt. So should homeowners be super concerned right now?
No, not at all. I mean, if you're a homeowner, what doesn't change is the fact that your payment is due at the same time every month. Fannie Mae and Freddie Mac are not lenders, so they don't make loans, and they're not servicers, meaning that they don't post payments and things like that. So most people that have a loan that's either owned or guaranteed by Fannie Mae or Freddie Mac, they don't even know it. And the reality of it is, for most homeowners, it doesn't change the fact that you still have to continue to make your payments every month.
What is the impact then on the general public, given the troubles they're having?
Well, the good news is that the impact is essentially nothing because of the fact that the Federal Reserve and the Treasury bellied up to the bar and said, yes, that long-held assumption that everybody's had about an implied government guarantee of these companies is correct. And yes, we're not going to let them fail. We are going to provide them with whatever capital they need if they should need it. And what that basically means is it's business as usual. The lanes on the mortgage freeway are going to remain open. You'll be able to get a loan, this month, next month, and into next year, because the Treasury and the Fed have assured that Fannie Mae and Freddie Mac are open for business.
But could the fact that the government had to step in and give them this bailout have a ripple effect throughout the rest of the economy?
Well, I think that ripple effect would have been much more significant if they had instead given the cold shoulder to Fannie Mae and Freddie Mac. In that situation, we would have seen a significant rise in mortgage rates. We would have seen a significant cutback in the amount of available credit that borrowers could get. And instead, it's basically business as usual. For years, Fannie Mae and Freddie Mac have borrowed at attractive rates because investors assumed that the government would stand behind them. And the government, going from a don't confirm or don't deny stance, has now basically said, yeah, we stand behind them. We'll do what it takes to keep them operating.
Despite all the concern, interest rates on 30-year fixed mortgages remain relatively low. Do you think we'll see interest rates rise again because of this bailout?
Not because of this. I mean, I think the likelihood is that mortgage rates may rise, but that's largely because of the inflation picture. There's a lot of concern about inflation out there, and that's something that ultimately could drive mortgage rates higher. If you're a prospective borrower, your risk is always to the upside. Your risk is always that rates could move up and price you out of that home that you have your eye on. So it pays to be conservative. Lock in that rate if it's affordable now, and don't gamble that they might come down, because they may not.
The Treasury will assume a lot more debt of its own because of this bailout. What other types of loans could be impacted by this? For example, student loans, car loans?
Well, we're having to knock over some dominoes to get from here to there. But basically, if the Treasury does need to provide additional capital or back up either Fannie Mae or Freddie Mac, they're taking on the responsibility for a lot of additional debt. That's something that could ultimately, if it came to that, push up interest rates for the Treasury to borrow money. That's the baseline for the rest of us when we borrow, taking out mortgages, when small businesses and large corporations borrow money. A lot of loans that are in existence are priced based on what the government pays to borrow. If the government has to pay more, we'll all have to pay more.
Do you think that will happen?
I think that that's unlikely because, again, what we've had here is just a crisis of confidence. It's not necessarily a crisis with the ability of Fannie Mae and Freddie Mac to operate as going concerns. And I think that the Fed and the Treasury have averted a disaster by basically stepping in and saying, hey, we've got your back. They're going to continue to operate, and the mortgage markets will continue to function.
Let's talk about IndyMac. Given the concern that several additional banks could be in similar trouble, is the average person's money safe in his or her bank?
Yes. If you have money in the bank and it's an amount that's fully covered by FDIC insurance, you don't have to worry about the bank failing. If the bank fails, it's the bank's problem, not your problem. The people that do have to worry are those that have more money in the bank than is covered by deposit insurance. And if that's the case, that's a situation that you want to remedy now, and do it regardless of the health of the bank. Transfer some money to another bank so that you have that coverage, or just retitle the accounts, keeping the money at the same bank. You want to make sure that whatever deposits you have at the bank are fully covered by deposit insurance. Not having that is like driving around without your seatbelt on.
You're referring to the fact that only $100,000 is covered by the FDIC in a bank account in this country.
And yeah, correct. And $250,000 for retirement accounts. So if you have $150,000 sitting in one bank account, that's a situation that you need to fix. You can either move half of that money to another bank, or you can just move it to a different account, say a joint account with a spouse as opposed to an individual account in your own name. Setting up separate accounts at the same bank under different names is a good way to lift that ceiling of coverage.
All right, Greg McBride. Mr. McBride, thanks so much.
Thank you, Katie.